Martin North, John Adams, in the interest of the people. Hello, John.
Hi, mate. How you going?
Good. So we're recording this on Tuesday evening after the Reserve Bank announced its rate cut.
Yes. So significant day in Australian economic history of the official cash rate going to 0.75%, the lowest on record. The RBA had a whole series of reasons why they decided to cut. But there's a bigger story to explain to the viewers beyond what the RBA has officially said and what the mainstream media is telling the public. The way I look at where we're up to in terms of the cycle is the debt bubble is falling apart, and we're going to go through a whole series of indicators that point to that, and then sort of dovetail that into the RBA decision. And then obviously try to explain to the viewer, what is the broader context? What's really going on?
Yeah, I think that's really important because I don't think that the Reserve Bank's commentary today is actually that credible, and it's missing a whole lot of really important stuff. So we're going to touch on some of that, aren't we?
Yes, and before we get into it, one of the key things for the viewers to think about is in 2008 when they cut to 3%, this was emergency levels. Well, we are at 0.75. Well, if 3% is emergency, well, what is 0.75, Martin?
Well, it must be at least red alert.
Red alert.
Yeah, that's exactly right.
I mean, look, perhaps it's Armageddon levels.
Well, okay, we're in a new environment. Rates are lower around the world, right? But fundamentally, nothing has changed from a decade ago. We've still got precisely the same issues in play and no way out.
Well, we have the same issues, but the issues are much more significant and much more enlarged because the debt bubble is at astronomical levels compared to 2008.
Yep, absolutely. The numbers are bigger. More economies are caught up in it. There's less room to move because of where rates are, and a whole bunch of international issues over the top, as well as the local issues. But I think the local issues are probably where we should spend a lot of time today.
Indeed. So when I say that the debt bubble is falling apart, I mean, there's a number of things that I look to in recent data sets, and I'll get you to comment with some of the things you've been looking at that point to me that things are starting to go like amiss in the economy. So the first sort of thing is credit growth. Now, why is credit growth important? I mean, this goes back to Steve Keen's work that when you have a bubble, what drives the bubble, and those sectors around the bubble like finance, construction, retail, and real estate in particular, it is the growth of debt. And so what we have seen is, over the last decade, we've seen a couple of periods of where credit growth has gone weak, and to keep the bubble going, they have continued to fuel more debt. And like to fuel the growth of debt, and that has obviously meant that more households have got deeper and deeper into debt. But yesterday, as in Monday, the RBA released its latest figures for August in terms of credit growth to housing, which I think is one of the more important figures that the RBA publishes, and it came in at a record low at 3.1%. So that was there. I mean, if you looked at annualized credit growth for investors, it only grew at 0.1%, which was at a low. And the previous 2 months, July and August, credit growth to investors, property investors, have actually been going backwards. So you've got that on the mortgage side, and then on the non-mortgage side, annualized credit growth to what the RBA calls as other personal, it came in at negative 3.4%. So early this year, one of the things we talked about is that one of the reasons why non-mortgage debt was shrinking was because people were refinancing and taking debt from, say, credit cards, car loans, overdrafts, etc., and personal loans, and putting that under the mortgage. But even though credit growth is continuing to weaken in the mortgage area, in terms of non-mortgage debt, it's still going backwards, and that's obviously going into one of the next factors that we've seen is households in trouble with debt, and obviously a massive fall in consumption. So when we look at households struggling with debt, so Friday last week we saw that the RBA released the June number for the household sector number of ratios. So one of the key ones I like to look at is household debt to disposable income. It came in for the June quarter at 191.1, a record high. So obviously, debt to income continues to exacerbate in the economy, and that's obviously significant. So now we're probably around the Irish 2006 levels. I think by 2007, Ireland got about 200% because the debt kept on growing. But even if it was growing at a slower rate, but the debt is growing faster than incomes. And then after the GFC, when incomes fell because of the deep recession in Ireland, I mean the ratio went up to about 210%. So we still have a way to go to reach Irish 2007 levels, but we're probably around 2006 levels in terms of where we are on Ireland on this particular metric. Noting that on other metrics like household debt to GDP, we are beyond what the Irish were anywhere through their through the boom cycle. So you have that. Obviously, when you look at annualized growth in consumption, we are at the slowest pace since 2012-13. So only growing by 1.9%, and that's obviously one of the reasons why we have a recession in retail, and we're seeing job losses happening there and consolidation in the retail sector. If you look at the national accounts, the household savings ratio has fallen to its lowest level since the GFC to 2.3. And that was for the June quarter. So, and then obviously your data set, mortgage stress is at an all-time high. So basically everyone's deep in debt. Less people are saving. People are not spending. And obviously people are stressed. And then obviously there was a recent story that the ABC said that 600,000 households, Australian households, are struggling to pay rent. So people are struggling to pay either their mortgages or paying their rent. And so this is obviously one of the key factors that says that the household sector that has really been driving the growth in the bubble, because it's a household debt bubble, is starting to fall apart because households can't cope with the existing debt load, and there is no appetite among households to take on more debt. So before we go on to some of the other factors, do you want to maybe make a couple of comments?
Well, I think there's 2 points. The first is, the mortgage stress data is looking pretty bad again this month. So last month it went sideways. This month it's up again. I'm running the numbers now. So there's well over 1 million households now struggling in terms of mortgage repayments. That's the highest it's ever been. Mm-hmm. And that's the workout of big mortgages, flat incomes, and rising costs.
Yep.
So the other thing to think about is that the numbers will be a lot worse, particularly the per capita numbers, right? If you look at those relative to the total numbers, because of the high migration that we've had, in fact, the migration has been supporting the growth numbers in Australia. If those numbers were actually looked on a per capita basis, then we've actually had a recession for the last 2 to 3 years, right? In real terms, on a household basis or an individual basis. So that's something to bear in mind, right? So it's not like the economy is actually looking really flash. It's only looking really flash because of the number of growth because of the population growth, right?
Yes.
And that is something which people forget all the time, right? Just because we're getting bigger as an economy, that doesn't necessarily mean we're getting better as an economy, right?
Exactly.
And I think that's worth thinking about. And then finally, just the building approvals number, which came out today as well, right?
Yeah.
It's worth just noting that. It was down again, right? Dramatically down, and particularly the high-rise sector, which was significantly off, right? And, on average, if you go back 3 years, there were 20,000 approvals a month. We're down to 15,000 approvals a month now. And there's a strong swing towards houses relative to the high-rise sector. So that's a very big drag on the construction sector ahead. And I'm already seeing more traders looking for work, not finding work. And in my surveys, they're basically saying, we're going to be able to work very soon.
Indeed, and look, I do think you make a very important point, because I mean, when we did the show with Edwin a few months ago about the high rises, what did we say? Do a Royal Commission, find out how many dodgy buildings there are, get to the bottom of it, and by telling the public the real story rather than trying to do a cover up, you actually going to you actually will provide confidence into the market if you can show that you're taking serious leadership on it. But the obfuscation, particularly from the New South Wales government, with Opal and Mascot and some of these other buildings that are out there, I mean, confidence in high rises have just fallen through the floor. And to be honest, I mean, like unless if you can get an engineer expert to certify that the building, the apartment you're about to buy, look at that it is up to a particular quality, you'd be mad to put $500,000 to $900,000 on a high rise in the capital city because it's just too risky, because you don't know what you're buying. And not only do you don't know what you're buying, the people who you think you can trust to tell you what you're buying won't tell you the real story.
Yeah, and it's worth highlighting that it's not uniform across the country, this, right? If you look at Canberra, right, in the last couple of years, 90% of approvals in a month were actually for high-rise.
Yeah.
And that's dropped away dramatically, right?
Yes.
So that's a really interesting microcosm of the issue that we've got here, right? Because these defects are not just in Sydney and Melbourne, they're in all the regional centres as well and the other major cities. And so this is going to be, I think, a very significant drag, because my surveys are saying that households are not interested now in looking at high-rise, even with 30% discounts, because there are too many unknown unknowns.
Absolutely. And the other point I would just make in terms of building approval, so when I looked at the data today from the ABS, I mean, when you looked at the total number of approvals for all of Australia, it was the weakest monthly number since January 2013. And obviously, a lot of these figures are the weakest since 2012-13, and we'll explain why that is significant shortly. So we have weak credit growth, falling building approvals, households struggling with debts, consumption down, savings are down, and then obviously when you look at the employment sector, so it's a couple of points to make here. So we did see in the last unemployment publication by the ABS a slight uptick from 5.2 to 5.3%, whether you're looking at trend or seasonally adjusted data in terms of unemployment. We have seen that with job vacancies. If you look at the RBA chart pack, you're seeing that job vacancies are pretty much peaked and job vacancies are falling. And in a previous off-camera conversation that you and I had, I think your data are saying that retail, construction, and the small business sector, that's where a steep fall in job vacancies are occurring. And then obviously we're seeing more stories in the press around job losses in these key bubble sectors that have been supporting the bubble. Obviously we've heard about a retail recession happening, and obviously you can see a whole bunch of empty commercial real estate all over the country. And I think last month I had the opportunity to go with Robbie to Surfers Paradise, and you see a lot of empty commercial real estate along the retail strip up there. So that was one example. But obviously even here in Wollongong, you go down to the Crown Street Mall and there's a lot of empty shops. So that's again evidence of what Edwin has been saying about oversupply around the building of commercial real estate, whether it's for retail or for other purposes. So you basically have that. So obviously, on the 29th of August, so that we're talking about retail, just to go to construction. So on the 29th of August, the ABC reported that work in the construction sector fell by 11% in the last 12 months, mainly driven by residential construction. So obviously, some of the state governments and the federal government is trying to offset some of the job losses in residential construction with infrastructure projects. But I think it's fair to say that so far there's not enough infrastructure projects to mop up a lot of that slack that's coming off the construction sector. Because and one point to make there is we had the mining boom, and then that sort of came off the boil in 2012-13, and then a lot of these people who worked in, say, the Northern Territory, regional Queensland and WA, where did they transition to? They transitioned into construction, and basically the last 5 years we've seen this, a new form of construction boom, and now all of these people are losing their jobs, and there's no escape hatch in terms of going back to mining. And then obviously, we've looked at retail, we've looked at construction. Then obviously, when you look at residential property listings, I mean they are low. I mean, you did a recent post with Edwin about what's happening there. I spoke to Edwin yesterday. He said that listings in Sydney are about 17,000. He said that for a number of real estate agencies, they need listings at about 21, 22,000 so that they can actually generate enough activity in the market so they can make commissions. So a number of agencies that Edwin says are hanging on, for dear life, and that if these listings don't come, and it's an interesting phenomenon because this is one thing that you and I talked about off camera about, we were expecting listings to rise in the spring season. Well, that hasn't happened to a large extent yet, and if that doesn't happen, we will see businesses close and jobs lost in the real estate sector in the next 3 months.
Yeah, and on that particularly in my surveys, there's a big swing in terms of attitudes, right? So 3 months ago, there was quite a strong expectation from households that they would put their property in the market. That's gone away, right? So I don't think we're now going to see a big uptick in listings in the next couple of months.
Yeah.
Which means that two things. Firstly, real estate sector is going to really struggle. Second is that the small number of properties that are being sold probably will be sold in some places at more inflated prices. But that shouldn't be interpreted as a recovery of the property market at all, right? It's a function of very low volumes. It's a function of weird supply and demand issues in particular locations. And the dynamics in, for example, some of the upmarket areas in and around close to Sydney, compared with in the regional and in the outer lying areas of Sydney, over in the west, are completely different. So I think we need to be careful in calling anything other than property market is in difficulty.
If the property sector is in trouble, we know that the bubble is falling apart. And so we've sort of laid it out here. Credit growth, building approvals, households struggling with their finances, debt load, savings, consumption. And obviously we're starting to see key sectors around this bubble falling apart. And we're seeing, starting to see some job losses in these sectors and job vacancies going down. So when we look at, again, what is my Armageddon thesis? It is that that when you have a bubble, real resources get concentrated in certain sectors: finance, construction, retail, real estate, etc. Those businesses and individuals, employees who work in these sectors earn super profits and super wages. They then enter into debt commitments at those super levels. And then once it starts to fall apart, they realize they can't make those debt obligations. And then that's when they start to get in trouble in making servicing those debts. And then when you get a sufficient number of those people who can't pay those debts, that's critical mass. That's a systemic crisis. So we're starting to see that unfold, and obviously this is why the RBA, as well as the Morrison government, have been desperate to inject stimulus into the economy to keep the show on the road. And obviously we've seen today was the third cut since the federal election. So we had 1.5% on election day, and now we're at 0.75. So we've laid it out. In terms of what we think is happening in the economy. And obviously, what did the RBA sort of say in their statement to justify this cut? So they talked about downside international risks. The trade war was one thing. Even though we have a strong trade performance, and we apparently have a current account surplus according to the ABS. So the trade wars so far, according to the trade numbers, haven't impacted our exports to imports ratios. So that's one. So I think those downside risks should be discounted to date in terms of having impact on the domestic economy, because the trade numbers clearly say that we're not being affected by the trade war.
Yeah, it's almost a convenient excuse, isn't it, to blame the international situation, right? It's also worth noting, John, that for the first time that we made more investments offshore than coming the other way, right? It was in the last statistics. And that's because all of the superannuation savings that households have put in to the superannuation system is looking for a home. A lot of that money has gone offshore because they can't invest it locally.
Yeah. So you have that. Obviously, the RBA talking about weak Australian GDP growth, so 1.4% annualized. Talked about weak and uncertain outlook for consumption. So we talked about consumption, and obviously one of the key points, and I think they said this in response to some questions that Tim Wilson, the member for Goldstein, put on the record at a recent Economics Committee hearing. They said that. That the fall in consumption in 2018, in late 2018, in November, December, the RBA completely missed that. So the RBA was expecting strong consumption growth late last year. They completely missed that. Yep. And obviously consumption has continued to weaken. And so when they say uncertain, so the thinking by Philip Lowe, and this even goes back to Philip Lowe's, when he spoke at the National Press Club, I think in February, yep. when he said that, even if we inject stimulus by cutting rates, it'll be sufficient to keep consumption going, to keep the bubble going, and to keep the GDP growing. Well, that obviously hasn't played to date. And when they talk about uncertainty, I think the RBA sort of knows that even this cut won't be sufficient to inject people to spend, particularly because two factors. One is there's a lot more gloomy commentary. Even with the cut in rates, we have seen a dip in consumer confidence as well as business confidence. But the other key point is that as they cut rates, and this is something you said to me off camera, is that households are using any savings they're getting from refinancing, or if they're on variable interest, not to consume but to pay down debt. Yep. So obviously, these are some of the factors around uncertainty around consumption. Weak wages growth and weak growth around household incomes. Slow employment growth, including job vacancies, and obviously, the inflation is below the RBA's 2 to 3% medium-term target, and they say, well, we need to cut to get inflation up. Now, that last point of logic makes no sense. It doesn't benefit households to make cost of living even more exorbitant than it is now. So if inflation is at 1.6 now, the official number I think is completely bogus because the ABS rigged the inflation statistics, and we've talked about that in a previous post. So so if it's 1.6, just take the 1.6 and say, well, we don't want it necessarily any higher, because that's actually going to squeeze households, which means it's going to make debt serviceability even tougher. But these were the key factors that they basically outlined in their decision, and they said at the end of the statement was that that they are prepared to ease monetary policy further, if required, to support, quote, sustainable growth in the economy, full employment, and the achievement of inflation target over time. So they're saying, even though we cut today, this is the third since the election, this is not the end. There is more to come, but obviously we're getting closer and closer to that zero bound. And obviously this is where our commentary about negative interest rates and the cash ban and all of those other issues come in, because we're getting closer to that critical point. Yeah, and I think it's just worth highlighting. The RBA some little time ago said, actually, a lower exchange rate would help us to achieve our inflation target, right? So they were actually thinking that they could import inflation because of lowering the exchange rate. That's and right. That would be positive, right? And you've made the point, and I want to make it again. Higher inflation in Australia at the moment, with incomes so low, is actually not going to help anybody. Precisely. The RBA's logic. Look at the data's crap, and the RBA's logic around exorbitant or high inflation rates. That doesn't have justification. So basically, we're seeing a whole bunch of weak data. Even though here's the thing, the RBA, like the mainstream media, is saying that property prices back up based on core logic, and you and Edwin have spoken at length about some of the problems with the core logic index, about the design and the quality of the data, and the delay in the data and where that data is coming from. So obviously, because we have relatively low volumes, should we read too much into property prices going up in Sydney, Melbourne? In the span of the Irish housing crisis, which went for 4.5 years, there were, speaking to a number of Irish contacts, there were at least 2 times where in prices went up during that 4.5 years, and in those two periods that I was told that prices went up, all the spruikers, the establishment from the government to the banks to the property sector to the media, they all said this is the bottom, jump back in, And so even though we're seeing a slight uptick in property prices based on low volumes in Sydney and Melbourne, and I think CoreLogic is saying now Brisbane to a small degree as well. Perth is still falling, as well as I think Adelaide.
Yep.
So I mean, I don't think we should be jumping for joy about property prices now, purely because the all this other data doesn't support robust property price growth going forward. So that's what I would say on that.
And John, it's worth adding, I think, that some people have been arguing the reason that you're seeing property prices going one way and credit numbers going the other way is a function of the limited supply that we've discussed, and also the fact that people are paying back debt very heavily, right? Next week, we'll get the flow data from the ABS, and that will show us what the new loan volumes look like. Now, interestingly, quite a few of my industry contacts have said there was a bit of a pickup in June and July, but that's now decaying as well. And if that's the case, then the chances of the property market continuing to surge forward, I think, is almost zero.
Yeah. So, yes, and really to underscore that point, Martin, is, so I have a picture. So I want to put this picture up for a while on the screen. Now, this was a graph, like an earlier version that I showed in the debate against Christopher Joy. And basically what we see here on this graph is, the journey of annualized credit growth going back to 2008. Now, if we look at the graph, there were two times where credit growth basically fell or collapsed. One was after the GFC, where credit growth was about 12% and it fell down to 6.4%. So by May of 2009. Now, how did they get credit growth to get back up for households to borrow more money? We saw a massive intervention by the RBA, cutting rates from 7.25% to 3%. We also saw the RUD stimulus package, in response to the GFC, as well as the first home owners grant. And obviously, on top of that, you saw massive global stimulus from China, from China, but also from the United States as well. So then it went up to from 6.4 to 8.2. And then we saw ongoing weakness going into 2012-13, and so obviously we hit a new low at 4.4% in January 2013, and then the government was able to get credit growth back, the government was able to get credit growth back up from 4.4, rising up again. So how do they do that? Again, massive intervention by the RBA, 4.25% cut down to 1.5. We saw a rapid growth in terms of interest-only loans, as well as in terms of the growth of investor loans. So, and obviously pre-Royal Commission, you saw a whole bunch of very loose and dodgy lending standards as well. A whole bunch of people got approved for loans that shouldn't have, particularly around when they were considering expenditure. So that took credit growth up to 7.5 by 2015. You saw a couple of interventions by APRA in terms of putting some caps around, in terms of the assessment rule, around 7%, around what the interest rate should be on assessments. There was a cap on how much the banks could grow their book around investor loans. There was a cap around interest-only loans, around 2016-17 as well. But obviously since then we've started to see credit growth start to fall away, and one of the key reasons why, so from 7.5 down to 6.6, you could say maybe some of these APRA changes had an impact, a small impact about the rate of credit growth. But what really fell away credit growth was the Royal Commission. The Royal Commission basically put the fear into the banks about criminal liability, but obviously we saw a whole bunch of pre-Royal Commission practices. A lot of those sort of went away, and that that plus, we could say, and we've talked about this in previous things, Opal Tower, Mascot Tower, and so you've got that, but plus, some weakness in the international economy as well, and obviously we're seeing households, exhibiting the behaviour that we talked about earlier, and that's why we have the lowest rate of annualized credit growth on record, and this series goes back to 1978. So now they are in a desperate attempt. So these two interventions in 2009 and 2013 was how they kicked the can down the road, and now we're here in 2019 with the biggest bubble ever in the country's history, and now they are attempting to unleash, more stimulus to try to rescue this, and so far that stimulus is not working because of all the data that we're putting out, because largely they've run out of ammunition. I mean, you look at the RBA in 2009, they cut by 4.25% from 7.25 down to 3, and then they cut by about 3.75% in 2011 from 2011 to 2016. Well, they don't have that runway to cut now, so they've gone from 1.5 down to 1.5 down to 0.75%, and now they're getting down to the zero bound, and they're wondering what they're going to do. And obviously, this is where they've started to flag this, and now there's more mainstream commentary around quote unconventional policy, and we will see unconventional policy in 2020 because they're hanging on for dear life to keep this bubble going. And what is that unconventional policy? So whether it's negative interest rates, quantitative easing, helicopter money, modern monetary theory, all of these things that we've been talking about, it is coming next year, and it will be unprecedented in Australian history. And they're doing it because the interventions, the whole host of interventions that the kitchen sink bubble strategy that we've outlined in a previous show, all of these factors that are being pushed by the Morrison government and the RBA to date, as well as APRA to date, have not been working, and they're running out of time to bring this bubble together, so that they can, avoid effectively accountability for one of the biggest economic crises in the country's history.
Yeah, and it's worth saying, John, I think, if you think about the stimulus they've done over the last year, so the tax cuts and those other things, right, that's about 1/8 of the size of the Rudd stimulus, right? Mm-hmm. So, again, we don't have the ammunition from the government. The Reserve Bank is already at very low interest rates, and you're right, it could do unconventional things and take rates negative, but they don't have that same ability to drop rates, right?
Yeah.
And we've already got way more debt than we've ever had before.
Exactly.
So we're starting from a much worse position in
Yes.
terms of the total debt that we've got in the system.
That's right.
Right?
That's right.
So all of those factors are in play, and so the chances of them being able to actually pull those levers and to be able to get the outcome they want is extremely low.
Yeah. So that is correct. So it's extremely low. So what I'm willing to go on the record tonight and say that independent. So let's put the rest of the world let's put that to one side for a second.
Yep.
So I mean, I think that we are seeing a slow moving train wreck that's going to result in further credit growth weakening, and these bubble sectors continuing to fall apart into the rest of 2019 into 2020. So we're going to see more weakness. We're going to see more job losses. More households will struggle. And the question will be, will the economy require more time for these households to be in a deeper financial position in terms of debt stress, to cause a systemic crisis? So even before Lehman Brothers went under, I mean the Irish banks were really struggling. Now we're not at that point yet, but we're seeing the process starting to unravel. And I mean there is a slight difference, and it's important we do a separate post on this. That one of the key factors that happened in the Irish crisis was that the ECB was raising rates in that environment, whereas we're loosening rates. And even with the loosening rates and the loosening credit and the loosening lending standards, and noting that on 1 January we're going to see this 5% deposit scheme come in. So far, this is not enough to rescue the bubble. And if we see these factors continue to play out, we could easily sail into a systemic crisis independent of the rest of the world. And yet, when you look at the rest of the world, I mean, we've got massive issues in the US banks in terms of these repurchasing agreements and the lack of liquidity in the short-term lending market. We saw a massive corporate collapse with Thomas Cook, and that's obviously going to make banks around the world more cautious about corporate debt. And we've got big corporate debt bubbles in a whole host of countries, including China, as well as in terms of the United States. And some of these other big corporates like Ford Motor Company and GE have recently been downgraded. And so again, if some of these big corporates overseas, if the overseas banks get into trouble and some of these European banks are struggling to make any money because of negative interest rates, one of these things could blow up. And with a debt bubble starting to unravel, that's Armageddon because too many households won't be able to struggle because they'll be losing their jobs, and they won't have the income to service these debts, and that's when they'll cause a disaster for the Australian banks.
Yeah, I think you're right. We go and look at the international situation, and there are lots of leading indicators of risk. The derivative sector's looking very shaky. The repo market in the US is all over the place, and the New York Fed is having to put more money in to try and get the rates to where they want them. Mm-hmm. But I think, my perspective is this. So far as Australia is concerned, we should be watching the unemployment number very closely over the next 3 to 6 months. Because if that continues to go up, with all the stuff that they're doing in terms of rate cutting and everything else, that will be the signal that the banks will start seeing real stress come through. We already know that 90-day defaults are higher than they've been. We already know that more households are struggling with those mortgages at the moment, right? The second one to, I think, highlight is that if we see that rate of change of credit continuing to decline, that is terminal for home price growth. It's not going to happen in that situation, right?
Exactly.
And if home prices start to go the other way again, and any of that optimism that was there in some people's minds dissipates, then you can bet your bottom dollar that that's going to be significantly negative. The third thing, I think, is that I'm expecting the exchange rate to continue to go south, simply because as the rates system works, I think the US dollar is down to 67 now at the moment, from what I understand. That's going to import inflation. So we're going to see those international price pressures coming in over the top. Those three are the factors that I'm watching in terms of how this plays out.
Indeed. So look, a short response. So credit growth, look, that is the leading indicator. If they can't pour more debt into the bubble's going to fall apart, like how we've explained this in this conversation.
Yep.
And that was one of the key points I made in the debate against Christopher Joy, that if credit growth continues to fall and people can't pay their mortgages, and you start to see unemployment rise in these key sectors, people will panic just like an island, and that will cause the systemic crisis. So falling credit growth will lead disaster to property prices, number one. Number two is, Christopher Joy, at the end of my debate, he said, no, credit growth will recover. And so far, that credit growth has not recovered. So Christopher Joy loves to say that he's always right, while to date, on the most important leading indicator, credit growth, he is dead wrong. And now, could it turn around? Potentially, but I don't think the RBA and the government have enough ammunition, particularly because households are so indebted to actually get credit growth back up. But we'll see what happens over the next little while. And the key point on that is, the RBA has released the August number. In 4 weeks, we'll find out the September number. And we already know the September number is weak because we've already had the Prime Minister in the last week and a half and the Treasurer calling on the banks to increase lending. Yep. You would not get the government saying to the banks, lend more, if credit growth was recovering. So that tells me that September is going to be another weaker number. And we probably will see a new record low for annualized credit growth when the September number comes out at the end of October. So that's point one. Point two is in terms of unemployment. So unemployment is a lagging indicator generally, not a leading indicator like credit growth. So that's important to note. The other thing to note is that you do not need a rise in unemployment to cause a crisis around mortgages, because all you need is in terms of, because remember, what is employment? 1 hour a week. Now, a lot of these people had full-time jobs. Some of these tradies were working 6 days a week when they signed these mortgages. So even if they're having casual part-time work, and they saw a loss of income of like 40-50% of their income, that's enough for them to spell disaster in terms of servicing either their non-mortgage debt or their mortgage debt. So obviously underemployment is going to be a more critical factor. Yep. So people now, if a systemic crisis does happen, you will see unemployment rise significantly. But to cause the crisis, people do not in the initial stage have to lose their jobs. They just have to lose the level of income relative to what they had when they signed the mortgage. So that's obviously a key point. And then obviously in terms of the exchange rate, so I have been saying that that they were going to junk the dollar. So remember what I said in the debate: housing crisis, dollar crisis. Well, they're going to sacrifice the dollar to keep this bubble going. Now they may not be able to save the bubble if they try, and they're trying at the moment. But we are seeing obviously a whole host of governments around the world junking their currencies, and the Australian government and the RBA are following in that suit. And that's obviously going to spell disaster for the long-term purchasing power of the dollar, and that's not good for the middle class or for living standards.
Yeah, so I think the message from today, John, is that there's a lot of important information coming, and the next 2 to 3 months will really be highly important to get a read as to where this is going to go.
Exactly.
John, thank you very much.
Thank you.
Martin North, John Adams. In the interest of the people, we'll see you next time.